Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. And let me tell you, BNY Mellon's latest report is quite a story about how a fund performs while telling you about auditing fees that seem surprisingly high. This annual report for the BNY Mellon Sustainable US Equity Fund dives deep into their performance for the year ending May 31, 2025. And wow, do we have a lot to unpack. We're looking at the annual shareholder report. It covers the period from June 2024 to May 2025. Now, this report breaks down the fund's performance costs and even its top holdings. While it might sound dry, there are some juicy bits about how this fund is managed and what it costs you, the investor. Let's start with costs. Imagine investing $10,000. For Class A shares, the cost was about $100, which is 0.95% of your investment. For Class C shares, it's a bit higher at $177 or 1.75%. Performance is key, right? For the year ending May 31, 2025, Class A shares returned 9.60%. Class C shares did a bit worse at 8.80%. Class I and Y shares were the stars, returning 9.89% and 9.88% respectively. Class C shares brought in 9.79%. Now, how does this stack up against the S&P 500 index? Returned 9. How does this stack up against the S&P 500 index? Well, the S&P 500 index returned a strong 13.522% over the same period. So the fund generally lagged the index, but why? The report says US equities did well overall, thanks to good company earnings and a strong job market. But our fund's performance relative to the S&P 500 index took a hit. While strong stock picks in industrials and not holding energy stocks helped, an overweight in healthcare with weak stock picking there hurt. Also, bad stock picking in information technology, especially software, dragged down the returns. It's a mixed bag with some good strategy calls and some quite costly mistakes. Looking at longer-term performance, the 10-year average for Class A shares without sales charges was about 10.99%. For Class I, it was 11.29%, and for Class Y, it was 11.29%, and for Class Y, it was 11.28%. The S&P 500 index, however, averaged 12.86% over the same decade. So, over the long haul, the fund also underperformed its benchmark. This suggests a consistent pattern of not quite keeping pace with the broader market. Let's talk numbers. The total fund size was $461 million. It held 46 different investments. The total advisory fee paid was a hefty $2,813. $684 turnover. Rate was 27.23%. High turnover can mean more trading, which can lead to higher transaction costs and potentially lower net returns, especially if those trades aren't consistently profitable. Now, for the really interesting part, the actual investments. The fund holds 99.2% in common stocks. Top sectors include semiconductors at 11.4%, software and services at 15.0%, and technology hardware at 7.4%. In terms of individual companies, Nvidia Corporation is a huge holding, making up a significant portion of the fund's investments. Other big names include Apple, Microsoft, Amazon, and Costco. These are mostly well-known large cap companies, which is pretty standard for a US equity fund, but the exposure to companies like Nvidia, which has seen massive growth, and services at nearly 15%, and technology hardware at 7.4%. In terms of individual companies, Nvidia, which has seen massive growth and the heavy weighting there, certainly shaped its performance. Let's look at how the fund made and spent money. Total income from dividends was about $4.3 million. Expenses were around $3.5 million, with the management fee being the biggest chunk at $2.8 million. After some reductions in expenses, the net investment income was about $779,000. But the real story is in the capital gains. The fund realized over $507 million in unrealized losses. Overall, the fund increased its net assets by over $44 million through its operations. Looking at how the total assets changed, we see that shareholders put in about $14.1 million more in net money than they took out through redemptions. However, they also distributed over $32 million to shareholders, mostly from realized gains. This means the fund actively returned profits to investors. These tables show us how much each share class earned or lost per share. For Class A, the net asset value per share went from $17.97 to $18.22 to $1.90, $7 to $1.42. The total return for Class A was 9.69. To Class I and Y, it's $0.70, 9.89%. The crucial metric here is the ratio of net expenses to average net assets. For Class A, it was 9.89%. The crucial metric here is the ratio of net expenses to average net assets. For Class A at Y, it's 9.89%. The crucial metric here is the ratio of net expenses to average net assets. For Class A, it was 9.89%. The crucial metric here is the ratio of net expenses to average net assets. For Class I, it was 9.89%. The crucial metric here is the ratio of net expenses to average net assets. For Class I, it was 9.89%. The crucial metric here is the ratio of net expenses to average net assets. Now let's talk about the auditor. The report mentions that the auditor fees for 2025 were $37,000 for the audit itself. Then there were audit-related fees of about $7,700 and tax services cost around $4,700. All other fees were about $2,800. Total fees billed for services rendered to the fund and its affiliates by the auditor were about $2,800. The total fees billed for services rendered to the fund and its affiliates by the auditor were over $1.5 million in 2025. This is significant. While auditing is essential, the sheer amount paid to services cost around $4,700. All other fees were about $2,800. The total fees billed for services rendered to the fund and its affiliates by the auditor were over $1.5 million in 2025. This is significant. While auditor were owed fees of about 77 potential conflicts of interest, even if they are disclosed. So what's my take on all this? The Ben Mellon Sustainable US Equity Fund is clearly invested heavily in growth stocks, particularly in tech. While this strategy has its upsides, as seen in the Nvidia holding, it also means the fund is highly susceptible to the volatile swings of these sectors. The fact that its long-term performance consistently trails the S&P 500 index is a major concern. It suggests that either the fund strategy isn't as effective as it could be, or the costs associated with managing it are eating too much into returns. The significant fees paid to affiliates for various services, while disclosed, warrant closer inspection by investors. Are these fees justified by the value provided, or are they more about benefiting internal relationships? The gap between returns and the benchmark, coupled with their hefty fees, makes this fund a potentially less attractive option for investors seeking growth unless they truly believe in this specific approach and are willing to pay for it. Alright, that's our breakdown of this annual report. What do you think of these numbers and what they signal for the fund's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.